Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I'm a business valuation expert in St. Louis, Missouri, focused on mediation and litigation. During this episode, we will discuss mergers and acquisitions and creating value before the transaction with Stephen White. He's an ESOP valuation expert and transaction advisor in Montclair, New Jersey. And I think that one of the things that you kind of touched on had to do with synergies. And
Mhm.
I think that this becomes an interesting discussion from a valuation piece. And I think that realistically, I think part of what you're also trying to provide us with today is like, what do the buyers look at? Like, right, what is a buyer looking at when they're looking at a company and what are
Right.
they finding value in? But a lot of these, I mean, do you think the reason that a lot of this activity is happening is because of synergies or is there some other thing at play?
Yeah, I do. I do. And you know what? And let me
And what does
back
that
up
even
just a
mean?
moment.
Like, yeah,
Yeah.
help people understand that.
Let me back up just for a moment because I think it's important for everyone to understand there's two different types of transactions. There's a standalone transaction and then there's an investment value, and that's more your synergistic type of value. From a standalone, real briefly, essentially what you're looking for is a buyer to come in from, and is that buyer is called the financer. So you're computing for that particular transaction a fair market value.
Mhm.
And I think majority of people understand what fair market value is. It's more of a trendy term in the valuation space. So as a financer, they're coming in, they're bringing their capital, they're buying that particular company, and they may even bring in a management team, a competent
Mhm.
management team to help come in and run the overall business. So ultimately, that fair market value, which is actually computed, is their benchmark as far as where they start negotiating, whether or not for the buyer side or the seller side. And it works perfectly well for them there. The other side of the equation, which is the investment value, that investment value is where they look for different benefits above the current value of that particular business. They look for synergies, things that are going to enhance what they currently have right now and the benefits that they particularly may have. So if you looked at it from a mathematical equation, you have your fair market value minus your investment value. That gives you what is called your acquisition premium. So that's above whatever that fair market value is. And the interesting thing about synergies is that one size doesn't fit all. What could be a synergy for my company may not be the same synergy for another company in the same industry, because there's different things in other companies that may be very attractive to them. I think
Mhm.
there's two different types of synergies that people will normally consider. There's something that's called a combinational, and then there's a transactional. Combinational is when you combine the two companies together and you eliminate some of the overlap. You see from an operational standpoint their assets. You see different things that you can maneuver around in order to enhance the value of the overall company, and you combine it. So it's kind of into it. The transactional one is pretty much the more exciting one because you see a company, you say, you know what, I want to buy that company. You forget all about the combinational sides of how that is going to be attractive and how it can help grow the overall business. The transactional side is, I just want that particular company. It could be from a competitor standpoint. You don't see it that often in middle market. That's more of a larger company type activity, but it
Right.
happens quite a bit. And they forget and it can mess up some of the synergistic things that you see, but it builds growth in the overall business. So synergy is going to be different for everyone at different times, and you hear synergies quite a bit, but I joke with my team all the time about synergy is basically 1+1=5.
Right.
You want to bring two companies together and know that it's going to create much huge larger value in
Mhm.
the transaction.
And sometimes with fair market value, I try to explain to like a seller that you're looking at what the minimum somebody would purchase is. Like if I came off the street and I didn't know anything about your business, I might pay on cash flow. I might pay on history of cash flow. I might not pay on what you think the future is going to hold. But if I'm
Mm-hmm.
coming from it from a synergy, I see something and that's investment value or something that could be higher than fair market value. But I'm looking at like, I want that product. Like that product
Right.
fits a niche that I need, and I could sell it to my million clients right now, right?
Right.
So I'm seeing something that I can do with what you have that maybe only I can do, and or I could make it worth more. So then you now have kind of these bookends where it's like, where is the value or the price between there? And
Hmm.
I think that that gets a little confusing when people are like, well, but I thought the value of a company just is like a number. Like there's just like this number out there. And it's like, well, that's, not necessarily true. There's a lot more that goes into that.
It does. It does. And oftentimes we look at valuing companies in the M&A space, to your point about fair market value, is that we look at the public markets, right? When you buy a particular stock, you're not buying the stock based on, even though you talk about what the performance has been in the stock and what the stock has done over the past history, you're not really buying it for that. You're buying it because of the anticipated appreciation that you're actually are going to receive, the dividends and the stock appreciation. That's why what you're buying. So you're buying the current value of the stock, not what the stock has done in the past. And the same thing applies here. So your fair market value is your baseline, to which you were referring to. You as a buyer and you as a seller are expressing where this company could potentially go, whether or not it be from a standalone or it could be from a synergistic standpoint. It could even go higher from a synergistic standpoint. That fair market value is the investment that you plan on investing in the company, not the investment value. The investment value is where this company will eventually go, that you as an owner now will be able to benefit from. And that's where some deals just fall apart.